Hello everyone, I'm Aansh Gupta, a BMS 6th semester student, giving a presentation on the topic Foreign Currency Convertible Bonds. As we know, FCCB is an instrument of raising capital from international market. So let's first discuss why the need for raising capital from international market has risen. So with the opening up of Indian economy, the corporate sector has got the opportunity to raise resources from international market for two specific purposes. To meet the requirement of foreign currency for import expansion and other business purposes. So because of globalization and liberalization, this need has risen. And second, to lower the overall cost of capital as international resources are likely to be cheaper than in India. So the cost of capital in foreign countries is expected to be lower than the cost of capital in India. So how do we raise money in an international market? So the instruments used for raising international capital are, so the major instrument is euro issue and we divide other instruments within it. Euro issue. So a euro issue is a issue where the securities are issued in a currency different from the currency of the country of issue, and the securities are stored in international market to individuals and institutional investors. Euro securities are negotiable and transferable securities distributed by a syndicate of market intermediaries and underwriters. So then euro issue is also divided in depository receipts and foreign currency convertible bonds. So first discussing what a depository receipt is. So a depository receipt is basically a negotiable instrument denominated in US dollars that represents a non-US company's publicly traded local currency, Indian rupee shares. Currently, the underlying shares can only be equity shares in theory, though a depository receipt can also represent debt instrument. In practice, it rarely does. So it is further divided into American depository receipts and global depository receipts. Both are generally in terms of US dollars, whereas American depository receipts are generally issued and traded in US securities market, whereas global depository receipts are traded in global countries, in all countries except US. So now we'll be coming to foreign currency convertible bonds. So foreign currency convertible bonds are a special category of bonds. FCCBs are issued in currencies different from the issuing company's domestic currency. Corporate issues FCCBs to raise money in foreign currencies. These bonds retain all features of a convertible bond, making them very attractive to both the investors and the issuers. So convertible bond is a bond which can be changed into an equity after a given period of time. So these bonds have assumed greater importance for multinational corporations. And in the current business scenario of globalization, where companies are constantly dealing in foreign currencies, they become all the more important. So they are quasi-debt instruments and tradable on the stock exchange. They are quasi-debt because they can also be changed into, they are convertible bonds, right? So they could be changed into equity, and that's why they are called quasi-debt instruments. And they are tradable on the stock exchange. Investors, basically the investors of FCCBs are hedge fund arbitrators or foreign nationals. Since it's a debt to the company, FCCBs appear on the liability sides of the issuing company's balance sheet. Some more features of FCCBs are FCCB is issued as a bond by an Indian company, is expressed in foreign currency, and the principal and interest too are payable in foreign currency. So you have to pay both the principal, the interest in foreign currencies. So the maximum tenure of the bond is 5 years. FCCB is a quasi-debt investment which can be converted into equity shares at the choice of investors, either immediately after issue or upon maturity or during a set period at a predetermined strike rate or a conversion price. So this is somewhat like an call option, which can be converted into equity at a predetermined strike rate or conversion price. So a price is set at which the debt is converted into equity. That is known as conversion price. So as an investor in the equity, the bond holder has a call option in the sense that he has the right to buy equity at the set price. So this hybrid product of this is a hybrid product because it offers both advantages of equity and debt. It gives the investors much of the upside of investment in equity, and the debt element protects the downside. The FCCB may carry a coupon rate or can be zero coupon. So coupon rate is generally a specific percentage of interest that it carries, or zero coupon. Zero coupon basically means zero debt. You don't have to pay interest on it, but there is a specific amount which you have to pay after its maturity. In case the bond is not a zero coupon rate, the issuer would be under the obligation to pay the coupon rate at agreed intervals. So what are the advantages of issuing FCCBs to firms? The FCCB's issuance allow companies to raise money outside the home country, thereby enabling tapping new markets for investment options. This reason becomes all the more important for Indian companies, as India market has a deficiency of capital. So it enables Indian companies to go outside, go in other countries and raise capital for fueling their business growth. FCCBs are generally issued by companies in the currency of those countries where interest rates are usually lower than the home currency or the foreign currency economy or the foreign country. Economy is more stable than the home country economy. So, for Indian companies, the major markets for FCCBs would be developed companies like US, Australia, UK, because the interest rate there is much lower than the interest rate in India. Since these bonds come with an advantage to the bondholder, the coupon payments on these bonds are usually lower than a straight coupon bearing plain vanilla bond. This helps the issuer to reduce the cost of borrowing. So because these bonds come with an advantage to a bondholder, their payments on these bonds are usually lower than a simple straight coupon bearing vanilla bond. Exchange rate fluctuations in favor of the issuer can further reduce the cost of debt capital. So let's say uh, today the rate of dollar is $1 is equals to 70 rupees, and a company has to pay $5 for it as interest. So they'll have to pay 350 rupees. But if tomorrow the rupee appreciates and $1 is equals to 60 rupees, the company would still have to pay rupees $5. So but they'll have to pay only 300 rupees this time. So if there's an appreciation in exchange rate, then it's in the favor of issuers. The conversion of FCCBs into equity usually happens at the price already decided at the time of issuance and is usually at a premium. So dilution of the company is lower. So when FCCBs are converted in equity, at the time of issuance of share, they generally issued shares at the premium. So the less number of shares are given to them, and thus the dilution of the companies is lower. However, there are also some disadvantages to firms. Companies that borrow money via FCCB in foreign currency shall have to make the repayment in foreign currency on the maturity of the bond. The exchange rate prevailing on the day of maturity, if has moved considerably as compared to the rate prevailing on the day of the borrowing, may result in losses for the company. The exchange rate in a volatile scenario may cause cash outflows on repayment to be much higher than the saving in the interest rate. Thus, a cost saving motive may be totally taken off if home currency depreciates beyond the interest rate saving. Let's say they have taken a loan of $100 and they're paying 2%, 5% interest on it. So they're 5%, so they're paying $5. So the amount that they're paying, taking $1 is equals to 70 rupees, they're paying 350 rupees. The current rate of interest in India is, let's say, 10%, which $100 it equals to 700 rupees. So in case the exchange rate decreases to $1 is equals to 80 rupees, then although the company has taken 7,000 rupees in originally, now they'll have to pay 8,000 rupees. So the cost saving motive which was originally there is no more because of depreciation of the home currency. Indian currency, talking about in Indian context, it is talking about the Indian rupees. Issuing bonds in a foreign currency in a foreign risk market may also always be exposed to a legal, political, and economic risk of their foreign country. One may have much better idea about the macroeconomic condition of the home country compared to those in a foreign country. So in an ever changing economic, legal and social environment, it's very difficult to assess what the macroeconomic conditions would be. However, it's easier to assess the home market conditions. So they may not always be in our favor when we are issuing FCCBs. FCCBs continue to remain on the books of account as a debt until the time it is converted and continue to hamper the debt to equity ratio and other debt and interest coverage, service coverage issues. So the advantages to investors. Why would investors invest in FCCBs if there are no advantages to them? So the main advantages to investors are FCCB holders may choose to convert the bonds into equity to benefit out of the equity price appreciation that may have taken place. So if the conversion price was set up at 100 rupees earlier and now the stock price is 200 rupees, so that 100 rupees would be direct profit for FCCB holders. FCCB holders enjoy the safety of guaranteed payments on the bonds and may opt to continue with the bond if equity or depository received if conversion isn't more beneficial. So they always have the option to not convert their shares in equity and have the benefit of taking high returns on bonds. So the disadvantages to investors are if the stock prices do not appreciate and instead depreciate, the bond holders might refrain from converting bonds to equity and the money might have to be repaid by the issuer on bond maturity. Hence, if the company is going through a bad phase, the stocks may not do well and therefore may not be converted to equity by FCCB holders. In such a scenario, the already troubled company may face an additional burden of interest and principal repayment to be made to the bondholders. Hence, an FCCB may be suitable in a bull market scenario and may be affected by bear market phases. So it is possible that if this in the bear market phase, the stock prices depreciate and the bondholders are not keen on converting their shares into equity, converting their bonds into equity. So in such a scenario, it's the burden on the company increases of both interest and principal repayment. And if they go bankrupt, FCCBs are an unsecured bond, so FCCB holders would not get anything. So that's why FCCB may sound like a golden instrument, but it is suitable more in a bull market scenario. Then it may be affected by bear market phases. Now, FCCBs in the Indian context. Many Indian companies have used FCCBs to raise capital over the years. These companies include large caps like Reliance Industries, Larsen & Toubro, ITC, etc. It also includes mid caps like Adani Group, Biocon, etc., as well as small caps like Arvind Limited, Vikaranji Limited, etc. What after all is the reason behind this mad race of FCBs? Is it just one of the short-term fads, or it is something else? The story of the bullish stock market is known to everyone, and now it is the robust stock market has driven up investor appetite for local FCCBs. The benchmark Sensex has risen from 30,000 to as much as 42,000 levels. It's a big chain full of global investors who bought FCCBs at a strike price for stocks which may be lower than the current market levels. FCCBs have, however, taken a huge hit in the bearish phase which the Indian stock markets entered recently. So the conclusion is FCCB undoubtedly is an effective and efficient instrument for corporate financing, but the same cannot be regarded as a golden instrument for raising money in all situations. Having analyzed the pros and cons of FCCBs, it is clear that FCCBs can prove to be of utmost advantage in a booming market and cannot be the buzzword in a bearish market, which the Indian markets are currently experiencing. Since volatility is inevitable in the stock market, appropriate steps have been taken by SEBI by issuing guidelines for qualified institutional placements on May 8, 2006 to take care of fundraising by listed companies domestically in a bearish run. it is more suited advantageous to issue qualified institutional placements over FCCBs in a bearish phase because medium-sized companies who do not have a presence on a global scale would be able to raise capital domestically. The cost consideration and the time involved in such statements would be lower than those in an FCCB issue. Such placements offer new vistas to Indian companies for raising capital and also open more options to the Indian retail investors for investment. Since we are already discussing FCCBs, we can also discuss an equally good instrument, foreign currency exchangeable bonds, with a small distinction between FCCBs and the foreign currency exchangeable. So under this option, an issuer company may issue FCEBs in foreign currency, and these FCBs are convertible into shares of another company, offered company, that forms part of the same promoter group as the issuer company. So in other words, if A issues FCEBs, then the FCEBs will be convertible into shares of company B that are held by company A and where companies A and B form part of the same promoter group. So let's say Tata Motors is issuing FCEBs. So there may be an agreement where the shares which are converted are not converted into Tata Motors but are converted into TCS. So that is something that uh, in which foreign currency exchangeable bonds are used. So there's a fundamental difference between an FCCB and an FCEB, whereby in the case of an FCCB offering, the bonds convert into shares of the company that issued the bonds. While in the case of an FCEB offering, the bonds are convertible into shares not of the issuer company but that of another company forming part of its group. There are a couple of other mechanical matters that are of interest. In an FCCB, when the holder exercises the option to convert, the issuer company will issue fresh shares to the holder in exchange for the bonds. However, in case of FCEBs, when the option is exercised, there is no issuance of fresh shares. What occurs is a transfer by the issuer company of the share it holds in the listed company to the holder in exchange for the bonds. Further, although the FCBs are issued on the strength of the underlying shares held by the issuer company, it does not automatically means that the shares are pledged in favor of the SEB holder. In the event of bankruptcy of the issuer company prior to conversion, the position of the FCB holder would be only that of an unsecured creditor, and to that extent, this structure is not bankruptcy proof so far as the issuer company is concerned. So what we are saying is that we don't pledge shares in case of FCBs. There's generally a transfer of shares from the parent company to the promoter company, and it's not always true that these shares would be transferred because in case of bankruptcy, these shares won't be transferred, and since FCBs are unsecured creditors, they lose their funds. So that is all from my side. Thank you.